Have you heard of the Pandu syndrome? An article in a leading business daily explained that it is the new acronym for pump and dump stocks, and that tiny stocks from the semiconductor sector are now the tools for such strategy. For instance, the stock of RRP Semiconductors saw jaw-dropping 450 times returns in 18 months. It was trading at a P multiple of over 1000 times. But semiconductor stocks are not the only ones basking under the sun. Stock of a housing finance company with negligible sales, almost no growth, no profits, and eroding book value would typically be a pariah for long-term investors. But Samman Capital, the erstwhile Indiabulls Housing Finance, soared over 20% in days after offloading stake to institutional investors. The entity's fintech avatar got investors hooked. Under the guise of fintech, small finance banks, NBFCs, and wealth management stocks have been the darlings of Indian stock markets for a while now. Some are fetching valuation multiples that put the PE multiple of market giants, both in the financial and non financial segments, to shame. So, it is basically the race to 100 times PE or more that is keeping investors keen on such high growth stocks. Traders and speculators may have been the ones to create the bubble around semiconductor and fintech stocks. But there is no denying that some underlying fundamental factors are likely to keep these sectors in investor radar for a long time to come. Take financialization of Indian economy for instance. Government initiatives like the Jan Dhan Yojana and the growth of the UPI digital payment ecosystem have created a fundamental infrastructure for financial inclusion. The Indian stack, which is Jan Dhan, Aadhaar and Mobile, has facilitated creation of scalable financial solutions by providing essential infrastructure for digital payments, identity verification and secure data sharing through its diverse tech stack consisting of account aggregator, Aadhaar and allied Aadhaar-based solutions, UPI and more. The Indian stack is still continuously evolving with new digital rails such as the OCEN, which is the Open Credit Enablement Network, and ONDC, which is Open Network for Digital Commerce. And this can potentially have benefits at a global scale if expanded internationally. According to Moody's Investor Service, the fintech sector is a leading adopter of artificial intelligence for risk management and compliance in India. The stocks of relatively newly listed fintech entities that are leveraging the payments ecosystem have fetched valuations that are at a significant premium in compared to the incumbents. Stocks in the fintech sector like Zaggle Prepaid Ocean Services, eMudra and Network People Services Tech have distinct business models. However, the underlying premise for their valuation soaring higher is the same, that such services will have deeper penetration in India in the coming few years. Yet another segment of the market that has seen investor interest is the stock of depositories. The growth of depositories is closely linked to the expansion of India's financial markets. First, they have the untapped potential of leveraging India's 200 million odd demat accounts and benefit from India's rising retail participation in equities. The low penetration, which is less than 15% of Indian households compared to over 60% of US households, you have demat accounts, leaves a scope to tap nearly 800 million PAN card holders. Demat accounts are projected to reach 250 to 300 million by financial year 2030. Plus, there is a policy push catalyst. Plans like dematerialization beyond equities to insurance and academic records can open up new revenue streams for depositories. There is also a solid entry barrier to the business. Minimum net worth of Rs 1 billion prevents casual entrants and keeps the system efficient. Plus, a large portion of the expenses, which is nearly 60%, is fixed cost for employees, cybersecurity and IT infrastructure. A new entrant in the depository segment would face significant losses for a prolonged period while it gains market share. So, depositories function like monopolistic public utilities. By that I mean power grids or railways, and there is unlikely to be too much competition in the sector. In fact, many countries operate with just a single depository such as the US, UK, Japan and Singapore. There is also a high switching cost involved. For instance, for a broker like Zerodha to switch from CDSL to NSDL, the process of transferring critical data would be operationally disruptive and expensive, making client retention for a new depository extremely difficult. So, the two depository stocks in India, NSDL and CDSL, have sufficient upside in terms of valuations. CDSL earns around 76% of its revenue from its core high margin depository operations, showing a strong focus on its main business. NSDL, in contrast, earns most of its revenue, which is about 50%, from payment banking. But this segment is yet to meaningfully contribute to the consolidated profits of the entity. It is the high margin depository business, less dominant in overall earnings, that accounts for most of the profits yet. Each of the stocks may have a different trajectory of growth going forward, but it is certainly advisable that investors quit chasing speculative ideas in the semiconductor or fintech space and rather keep the high growth depository stocks in their watch list. Hope you like this video. Thanks for watching.